By Paul Dale, senior US economist at Capital Economics. Paul, lovely to have you on the program with us. What is the big driver of the US recovery right now?
Well, at the moment, it does actually seem to be domestic-based drive. We've seen this week that the ISM services-based survey has done quite well, and that seems to be translated into better news on the jobs front, which I expect to be confirmed tomorrow with some data out on employment in the United States.
And how difficult will it be to sustain this domestic demand, which you say statistics show that is contributing more to the recovery, when you have, for example, higher gasoline prices? Are American consumers going to struggle to withstand that?
Well, I think there are a few reasons to be a bit more optimistic about this recovery than previous recoveries, which have faded before long. For example, the interest rate sensitive sectors of the autos and housing markets appear to have turned the corner a little bit. And banks seem to be lending a bit more as well, which I think is going to support spending by both households and businesses. But you're right, there are a few risks. I mean, we at Capital Economics, we're not extremely bullish on the US economy at all. Gasoline prices could derail the recovery. There's a pretty big fiscal wall that could kick in at the end of this year. And also events in the Eurozone, I think, are still something to worry about too.
Will we see those concerns, or perhaps particularly the deficit, the risk coming from having to cut back on that? Is that going to come into sharper focus after the election?
I think it will, yes. Congress is going to have a very tricky period at the end of this year where it'll have to decide what to do with the temporary payroll tax cuts, the Bush tax cuts, and the automatic spending cuts that were part of the debt ceiling deal last year.
That could shave a considerable amount, or at least a sizable amount off GDP next year, couldn't it?
Yes, an incredibly large amount. I mean, it's worth nearly $400 billion, which is about 2.5% of GDP. So if current law actually takes place, there's little doubt the US economy will be in a recession again next year. Thankfully, I don't think the US politicians will be that reckless. They will come to some agreement and probably renew most of the tax cuts. Yeah. But you can't discount what
political risk.
Exactly. So you have to think about it as a serious risk to the US economy.
It's a complicated situation, isn't it? Because it seems as though those budget concerns, budget deficit concerns, a little bit on the back burner right now with an election coming up. The data has been fairly consistent, fairly positive in terms of the employment picture, in terms of housing. What does all this mean for the possibility of more QE?
Well, I think there is less chance of more QE now than there has been for some time. I mean, if you look at the hard data, there is less chance that core inflation will fall to a level that will worry the Fed. And I think there is more chance that the unemployment rate will edge down a little bit faster. So I think QE3 is pretty much off the table. I'm not saying it won't happen. You know, if the economy does hit another wall, then I think the Fed will act. But the main point really is that it's not completely likely now. Equally, though, the Fed isn't going to be close to tightening monetary policy for probably another 2.5 years yet.
Price pressures are weighing on policymakers' minds right now, aren't they? So would more stimulus put the Fed's inflation goal at risk?
I think the Fed will probably be worried about providing more stimulus at a time when core inflation is around 2%. And as you said, gasoline prices are rising. It's worth thinking about when they released the second round of quantitative easing. And at that point, core inflation was something like 0.5%. So that was why they did it, because they were really worried about a debt deflation spiral, which anyone who's looked at Japan is really not something you want to get into. So around 2% core inflation, I think the Fed will be worried about releasing more monetary stimulus to bring down the unemployment rate. But at the moment, the US economy, it does appear to be ticking along okay, so I don't think it's necessarily needed.
You still have a lot of cash sitting on corporate balance sheets. You know, that's perhaps one thing that we could... You're saying that bank lending is increasing, but nevertheless, that's something we could perhaps see more of in terms of driving the recovery. There are other risks in place. How much growth do we need to see in the US to sustain, say, a gain of 200,000 jobs a month, something on that level?
Well, I think around 2%, GDP growth around 2% should just about do it. I mean, previously you might have talked about 2.5%, but what's happened recently is that the labour force has been growing at a slower rate. So that means you need less new jobs every month to absorb those new workers. So that's it. Slower labour growth isn't brilliant for the long run, but actually it means you actually need slower GDP growth to bring that unemployment rate down. So there's a little bit of positive news there, but it's not something to get too excited about.
Paul Dale, senior US economist, Capital Economics. Thanks for your time.
Thank you.